Hi, this is Dr. Phil Rosenkrantz again with Retirement Planning, Part 4. Our topic now is investment strategy. Let's go to slide number 2. This is our basic approach. We're going to use some historical annual returns for different types of investments and as kind of a basis for our approach here. We're going to suggest diversifying your portfolio to protect against unpredictable markets or asset classes. And when I say the word portfolio, what that means is that's your collection of investments. You'll hear that word used among people when they're talking about investing. The book that we've been using suggests that you consider investing in at least 3 non-correlated asset classes. In other words, split your investments up into 3 different categories that don't travel together in terms of impact in the market. For example, if all of your investments were tied to the stock market and the stock market went down, then you're really hurting. But if only part of your assets were in the stock market and the other investments were in things that weren't affected by the market, then you can withstand just different changes in the economy much better. That's called diversification, and it's a fairly common practice. Well, anyway, let's move to slide number 3. We need to talk about risk because that's something that's very personal. Higher returns come from riskier investments. The riskier investments have greater volatility. In other words, they're not as guaranteed. And they can vary in a way that you can have some fairly emotional roller coaster type trips over a period of years as some of these investments dip down, and you're hoping and praying that they don't stay down and that they'll come back up. Then you get these real emotional highs when they do very well. Well, some people love that. Other people can't stand it. And so you adjust for risk by the type of investments that you take on. What we're talking about, though, is long-term results, and those are only obtained from long-term investing. And you have to ride out the cycles that are in the economy. And we're going to use some numbers, and we're going to come up with a composite rate of return on our investments based on our risk situation. If you're looking for a rule of thumb, here's one that I've heard several places, and that is limit your investment percent into high-risk investments to 100 minus your age. So if you're 25 years old, investing 75% of your retirement funds into the riskier type of investments is probably okay, because if you have some big hits down the line, you still have time to recover. If you're 50 years old, then you wouldn't want to invest more than half of your funds into risky investments because you don't have as much time to recover. Well, let's move on to slide number 4. Here are some of the different asset classes that you could invest in. These are different classes that if you went out shopping for investments, and if you told an investment broker that you were looking to invest in these areas, they would know what you're talking about. We have emerging market stocks, like e-commerce, for example, higher return, but it's higher risk. And U.S. small company stocks, large company stocks. Small company stocks, that's a higher return because the anticipation is that small companies will grow into large companies so that the value of their stocks will go up as the company grows. Whereas large companies are more at a maturity level, and so they're not going to grow as much. Then you could see some other asset categories on this slide. On slide number 5, we have some more. We have bonds now, And keep in mind, bonds are considered to be, in many cases, less risky than stocks, and the bond market oftentimes goes the opposite of the stock market. So a lot of people look at bond market as a non-competing way of investing and diversifying. And you can see on the list that there's also some more liquid type investments, money market and treasury bills, and then precious metals, gold being shown as an example. And so anyway, these are just some examples of different asset classes. So how would you use this information in your strategy? Let's go to slide number 6, and this is where the rubber meets the road. So let's say that you have a target return of 12%. One way that you could achieve that is if you invested 25% of your portfolio into emerging markets at 14%, 50% of your portfolio invested in small company stocks at 12%, and 25% invested in real estate at an anticipated return of 10%, then your composite return or your total return would be 12%. Now, of those three asset classes, you could have downturns in those markets in any one of those, but the other two could actually be going up. And so in the long run, you'll get your 12%. And even if one of those markets has some really bad years, you're probably still going to be in good shape. So let's go to slide number 7. So we want to achieve that return. Let's suppose that you have a 401k plan. I want to talk about 401ks for a moment. Let's say you have a 401k plan where you work. Many companies will actually match part of the money that you put into a 401k. So let's say you put in 6% and they're going to match, say, up to 4%. Well, that's really great. That's a very desirable, because not only are you able to put into the plan, but they're putting extra money in. It's really hard to beat those kinds of plans. The beauty of a 401k is that the money that you put into it is not taxed until you pull it out later on. So if you're making $50,000 a year and you put $5,000 into a 401k, that $5,000 is not taxable in the year that you earned it. And that lowers your tax liability. So that's a benefit right there. But then the interest earned on that 401k is not taxed either until you take it out sometime after age 59 and a half. So you could, within your 401k, then invest in those asset classes that we mentioned on the previous slide. In some 401k plans, you have to invest in company stock. That can be good or it could be bad. In the case of Enron, it was bad. But many companies allow you to invest your 401k money into different funds of all kinds. And that would be the vehicle then that you could use to diversify your investments into the different asset classes. My suggestion is that your best strategy is probably going to be to maximize your 401k plan and then balance the rest of your portfolio after that. Let's go to slide number 8, and I'm going to just casually mention a few other investment options. One is the individual retirement account, or IRA. And if you don't have a retirement plan, or if you have some extra money outside of your other investments, let's say outside of your 401k, then you might want to consider investing in an IRA. It's tax deferred as well, and it can have a nice impact on your tax liability. Another option is a Roth IRA. The Roth IRA uses after-tax dollars. In other words, the money that you invest, you've already paid taxes on. But here's the beauty of the Roth IRA, and that is there's no tax on the earnings later on. So if you're a young investor, or if you've got money you've already paid taxes on, a Roth IRA is great because then you never have to pay taxes on that investment. Other options that might be viable include I-bonds. That's a relatively new type of savings bond that the government's come up with, and it has some nice features that you could explore. And then finally, life insurance. If you have dependents, then you probably want to study your life insurance options carefully. Life insurance generally falls into two types. There's term life insurance, where you pay so much a month, and if you were to die, then your beneficiary, whoever you're leaving your benefits to, would get the life insurance benefit. With term life insurance, the rates are low, but there is no cash value of the life insurance policy. There's only a death benefit. The other type of life insurance is whole life or universal life, where you pay more for those policies, but some of the money goes in to build up a cash value, and then that cash value would go to your beneficiary along with the death benefit. It becomes part of the death benefit. The advantage of whole life insurance is that some people consider it to be permanent insurance because you just leave that cash value in there, and even after the life of the insurance policy, it's there to provide for your beneficiary. Another advantage of that type of insurance is that you can borrow from the cash value. And in some cases, if you want to pay it back, it's at zero interest, or you don't necessarily even have to pay it back. It just reduces your death benefit. Well, anyway, the best advice I could give you about life insurance, because I'm not a life insurance agent and don't have the qualifications to give you much more advice, but from a personal experience in dealing with life insurance for many years, I think that the best thing that you can do is find a life insurance agent that has a lot of integrity and will tell you the truth and be honest and upfront with you and help you decide on viable options. If you're buying life insurance from an investment company, or if you're buying investments from a life insurance company, then you want to look at real close at what they're telling you. So anyway, that's the end of my advice. That's the end of part 4. And hopefully with these 4 parts and what we've discussed, those of you that are going to be doing the retirement planning project in EGR 403 will be able to work through the calculations and get to the point where you can do a sensitivity analysis and come up with your own plan. That's it. Thanks. Bye.